Stock Daily Insights. Your daily market compass.
Welcome to today's video. Our content is divided into two main parts. First, we'll discuss the broader market analysis. The US stock market has finally entered a rate cut phase. So the big question is, will the market soar or plunge after the rate cuts? That's what we'll explore in this first segment. In the second segment, we'll analyze several stocks that our audience has been following closely, including NVIDIA, Tesla, DELL, and Coin. A key point to note is that Tesla is currently in a consolidation phase, and I'll explain this in detail later. As always, please give this video a like before watching, and I wish you all continued success in the stock market. Let's first take a look at the NASDAQ. The primary focus here is on the moving averages, or what we call the ribbon. As you can see, the NASDAQ's ribbon has narrowed significantly, and it's highly likely that it will soon turn red. Currently, the NASDAQ has been in an overbought confirmation state since the fifth candle. After the rate cut today, the index spiked but then pulled back, ultimately closing with a loss of 0.3%. However, a positive sign is that the ribbon is narrowing. Unless the NASDAQ breaks below the lower boundary of the green ribbon with a significant downward candle, it's likely that the NASDAQ will turn to a red ribbon. Now, the big question, is there a risk of a major drop in the NASDAQ? Given the overbought confirmation, I believe a major drop is less likely. Instead, we might see some consolidation. If the NASDAQ stabilizes around the red ribbon, possibly forming bullish patterns like a bullish engulfing candle, morning star, or three-line strike, it could signal the end of the pullback and the start of a new upward wave. On the other hand, if the NASDAQ fails to hold the red ribbon and breaks below it, it would indicate that the second wave of the rally has not yet arrived, and we'll need to continue waiting. Let's discuss the key resistance levels the NASDAQ will face next. The indicator, Treasure Hunter, shows that there's a resistance level at 17,621 points, which is about 50 points away from the current price. This resistance level is relatively strong and will require a significant volume to break through effectively. For the NASDAQ, 17,621 points could be an important resistance level. Today, the NASDAQ reached an intraday high of 17,832 points before pulling back, making this level another critical short-term resistance. If the NASDAQ can close with a bullish candle and break through this level, the trend will likely strengthen. If not, the NASDAQ may continue to consolidate. Moreover, the NASDAQ has been in an overbought state since the fifth candle, indicating that the current rally, which started from the oversold confirmation, might be nearing its end. Will there be a second wave of the rally? It's possible, but the market likely needs a pullback. I think a significant drop is unlikely. Instead, we're more likely to see continued consolidation. Of course, there are no certainties in the market. After an overbought confirmation, the price doesn't always decline. If it doesn't, and instead continues to rise, we call this a refusal to drop, which could lead to a strong upward move. Today's intraday high of 17,832 points could serve as a critical level. If the NASDAQ closes above it with a bullish candle, we might see a refusal to drop pattern, leading to further gains. Otherwise, the index might continue to consolidate until the ribbon turns red and stabilizes, signaling the real start of the rally. Now, let's talk about the S&P 500. The S&P 500 has already hit new all-time highs ahead of the NASDAQ, and although it's also in an overbought state, there are a few positive aspects to consider. First, the two gaps that have formed since the start of this rally haven't been filled, which is a very bullish sign, especially the second gap, which has remained unfilled for 3 consecutive days. A gap that isn't filled within 3 days is often considered a strong gap. Additionally, the S&P 500 is still in a red ribbon phase, making it stronger than the NASDAQ. While the chart shows that the S&P briefly dipped below the ribbon, it quickly rebounded on an oversold confirmation, indicating that institutions were eager to buy on the dip. For the S&P 500, even though it's overbought, there is a short-term need for some correction. This correction doesn't necessarily mean a significant drop. The key is to watch whether the gaps remain unfilled. If the gaps stay intact, the S&P 500 could continue on a wave-like upward trend, potentially creating 4 to 5 gaps. However, if the gaps get filled after a period of consolidation, it could indicate that the following trend might not be as strong. The gap around 5,600 points can be used as a defense level, signaling that the S&P 500 could continue forming 2 to 3 more gaps in this wave-like pattern. Now, let's talk about the S&P 500. The S&P 500 has already hit new all-time highs ahead of the NASDAQ, and although it's also in an overbought state, there are a few positive aspects to consider. First, the two gaps that have formed since the start of this rally haven't been filled, which is a very bullish sign, especially the second gap, which has remained unfilled for 3 consecutive days. A gap that isn't filled within 3 days is often considered a strong gap. Additionally, the S&P 500 is still in a red ribbon phase, making it stronger than the NASDAQ. While the chart shows that the S&P briefly dipped below the ribbon, it quickly rebounded on an oversold confirmation, indicating that institutions were eager to buy on the dip. For the S&P 500, even though it's overbought, there is a short-term need for some correction. This correction doesn't necessarily mean a significant drop. The key is to watch whether the gaps remain unfilled. If the gaps stay intact, the S&P 500 could continue on a wave-like upward trend, potentially creating 4 to 5 gaps. However, if the gaps get filled after a period of consolidation, it could indicate that the following trend might not be as strong. The gap around 5,600 points can be used as a defense level, signaling that the S&P 500 could continue forming 2 to 3 more gaps in this wave-like pattern. Let's move on to NVIDIA. At a certain point, I mentioned that NVIDIA was in an overbought state, but it hadn't yet confirmed this overbought condition. We discussed this before the market opened on Monday, pointing out that if NVIDIA formed a bearish candle close to the narrowing ribbon, it would be a warning sign. At that time, I expected NVIDIA might find support with 2 or 3 bullish candles, but unfortunately, it has since closed with 3 consecutive bearish candles, which is a bit disappointing. Looking at it now, it's highly likely that NVIDIA will continue to follow the green ribbon downward until it stabilizes and transitions to a red ribbon, which might then signal a reversal. On Tuesday, NVIDIA started showing signs of overbought confirmation, which, from both a ribbon and overbought perspective, indicates that NVIDIA has a short-term need for a correction. If you hold NVIDIA stock, you'll need to watch a critical support level closely. Currently, the key support level is around $109. If this support fails to hold, we might see a retest of the previous $100 level. On the upside, $119.66 is a key resistance level for NVIDIA. Breaking above it could open up further upside potential. Now, let's talk about Tesla, a stock I personally hold, so I'll go into a bit more detail. Back on August the 30th, I noticed that institutions were buying on the dip. This was indicated by the blue candle signal. The purpose of buying on the dip is to prepare for a rally, so I suggested buying at that point with a stop loss set below the low of the blue candle. If the price breaks below that low, you exit. If it doesn't, it means the entry point is solid. So far, our buy-in near Tesla's low has turned out to be a good entry point. However, Tesla encountered some resistance around the $235 gap resistance level. Today, it touched a high of $235.68 but failed to break through effectively, showing that the gap is a significant resistance. The upper boundary of this gap is around $245, and these two levels will be challenging for Tesla to break through in the short term. We'll continue to monitor key patterns on Tesla's daily chart. You'll notice that after 3 consecutive down days, Tesla's volume has been increasing steadily, forming what we call a descending volume ladder pattern. This means that while the price is dropping, the volume is rising, which typically signals an ongoing consolidation. So when will Tesla break out of this consolidation phase? Most likely, it will need to form a bullish candle that effectively breaks above the high of the last bearish candle. If this happens, it could indicate that Tesla is ready to end its sideways movement and break out upward. If not, or if a low volume bearish candle forms, then this pattern analysis won't apply. Overall, I remain optimistic about Tesla. The reason is that the primary capital flow is still dominated by bullish funds, and these funds have been consistently flowing in. This is unusual because the stock price hasn't surged significantly, yet institutional money has been steadily accumulating since the dip. That's why I've held on to my shares, despite the consolidation, as it seems the uptrend may not be over. If you hold Tesla, I believe you can continue to do so, unless it breaks your stop loss level or the bullish capital flow turns negative. Now, let me explain why Tesla is currently in a consolidation phase. Looking back at the period between June the 14th and June the 17th, Tesla was also in a sideways consolidation for a while. During that time, a pattern called the flying change emerged, where 4 candles combined to signal a major shift. This pattern, along with a golden finger formation, led to a breakout from the consolidation, driving the stock price from $175 up by 50% in a powerful rally. Currently, Tesla's recent pattern is very similar to that previous consolidation. The flying change point is narrowing again. If this formation plays out like before, it could signal a major opportunity is coming. If not, Tesla might continue to consolidate. I now understand why institutions have been accumulating shares. They may be preparing for the next big move. If this accumulation phase is successful, the opportunity could be substantial. Next, let's discuss Coinbase. Coin. In the video we released on September the 15th, I mentioned that Coin was showing signs of significant institutional accumulation at a key low point in its recent trading range. After this accumulation phase, the stock rallied to its current level. At that time, I also highlighted a critical resistance level at around $170.76. Today, Coin reached an intraday high of $169.10, just $1.50 short of that resistance, before closing at $162. This shows that the $170.76 resistance level remains valid and continues to be an important threshold for Coin in the short term. This resistance level is crucial. If Coin cannot break through it, the stock might experience a pullback. Why do I say this? First, Coin is still within a broad green ribbon, indicating that it's in a larger downtrend. Second, according to the Treasure Hunter indicator, the main accumulation phase by institutions has completed, but their willingness to push the stock higher isn't very strong. Currently, bearish capital still dominates the market, though there are signs of a bullish counterattack with bearish momentum declining. This suggests that the bulls may be gearing up for a move. If Coin manages to gain bullish dominance at this level, it could indicate that the institutions are done accumulating and are ready to push the stock higher, potentially leading to a significant rally. However, it's essential to keep a close watch on the $170.76 resistance level. If Coin fails to break through, this could mark a short-term peak, so you need to be prepared to take profits if necessary. Now, let's move on to DELL. DELL is a textbook example of a stock experiencing a second wave of institutional buying. Earlier, when the stock was at a low point, institutions accumulated shares heavily. I also mentioned other stocks like AMD, Micron, and SMCI at that time, but chose DELL as the example to discuss. During this initial accumulation, the stock transitioned into a red ribbon phase, signaling the start of a bullish trend. The blue candle signal confirmed that institutions were entering a second phase of buying, which was followed by another rally in the stock price. As of now, DELL is still in the red ribbon phase, but it has entered an overbought condition. Although there hasn't been an overbought confirmation since the fourth candle, for those holding DELL, if the stock continues to be overbought, you might consider holding on. However, if an overbought confirmation occurs, it could be a signal to consider short-term profit taking. Let's also discuss DELL's key resistance levels. During its previous rally, DELL encountered resistance at around $117, which is where the market maker's cost is located. Although the stock reached a high of $117.70, it failed to close above this level with a bullish candle. Currently, the market maker's cost remains a key resistance on the daily chart, now around $121. Short-term capital has been accumulating since the $117 low, bringing the overall cost down to $112, which has now been effectively broken through. The $121 level is crucial for the daily chart. If DELL fails to break through this resistance, it could be a warning sign for investors. Lastly, let's talk about GEV, a stock that one of our students recently asked about, as it has seen significant gains. The student mentioned that they identified GEV through our software and bought in at around $170. The stock has since risen to over $230, and they're now wondering if it's time to sell. Despite GEV's significant rally, the stock is still in a healthy uptrend and hasn't entered an overbought phase yet, which is surprising given its price movement. From a broader trend perspective, GEV's red ribbon uptrend remains intact. The only concern is that the stock is now in the 8th stage of an upward structure, meaning it's highly likely to complete the 9th stage. Whether this 9th stage becomes a continuation pattern or a peak pattern is crucial. If it's a continuation pattern, GEV could see another rally. If it's a peak pattern, you might need to consider reducing your position. There's no need to completely exit your position, as the overall trend remains strong. Instead, you could consider buying back at a lower level if the stock pulls back. Additionally, GEV has already formed 2 gaps in its current run, and typically, stocks with strong momentum form 4 to 5 gaps in a rally. If GEV pulls back after completing its 9th stage, and the gaps remain unfilled, it indicates a very strong trend, suggesting there may be 2 to 3 more gaps ahead. Why has GEV been so strong? Looking at its capital flow, it shows that the stock is in a long-term uptrend with short-term strength as well, dominated by continuous bullish capital inflow. This is why institutional money is so important to watch. Consistent inflows can push the stock price higher, sustaining its rally. Thank you for watching today's market update. For more insights and daily stock market analysis, don't forget to subscribe to our channel and turn on notifications. Share this video with others who might find it helpful, and leave your thoughts or questions in the comments below. See you in the next update.